All right, guys, Pfizer and Rowe Price just reported. We're going to go through both of them, go through their reports, their analysis, and get you exactly what they did. Before we go, though, this Thursday, 6 p.m. Eastern time, we're going to have a free webinar. Click the link below on how to use options to generate extra income on stocks you own and stocks you want to own. So be paid basically extra money on stocks you already own and be paid to wait for stocks to hit prices you want to own them at. That's going to be incredible. This Thursday, 6 p.m. Eastern time. Click the link below. Let's go check out Pfizer and Rowe Price. So Mo, Pfizer just reported.
Yes.
Tell me what they reported.
All right. Yeah. So earnings came in $1.23 versus 98 cents. That's
expected.
A beat. Yep.
Oh
That's
wow.
A beat. Revenue came in 18.28 versus 16.6.
Wow.
That's a big beat.
Million or billion?
Billion.
All right, that is a big beat. Let's see how Pfizer is doing right now.
And I have some information from their press release.
They're only up 1%.
Yeah. So expected decline of their preventative COVID.
Well, of course.
Yeah. Revenue drove 26% of operational decrease. That's big. So that's my concern about this company is they were so heavily involved in vaccine, and now that that's coming off, now they have to normalize their revenues and profits. How do you do that?
So if you remember in our past videos, we talked about this all the time. Yeah. Guys, COVID is driving this. So here's an example. They just reported $3 billion for the first quarter.
Yeah.
First quarter of last year, they did 25.66.
Big drop.
Now, again, if you're new and if you're not new, you need to repeat this in your head. You cannot give too much value to a one-time event. Will COVID be around for a long time? Bill Gates, a lot of people think it will. Go ahead, Mo.
At the same point, they are still a fantastic company.
Oh, of course.
They are the guys in the world of drugs. They are the virus people. That's it.
I get that. But look at this revenue growth.
Go back there. Go back to
annual.
Third quarter of 2020. Look at that. Look at the revenue. 10.28 billion.
So let's go to annual. I mean, look at this big jump, Mo. They probably sold some things off, had some things fall into, 40, and then all of a sudden 81 and 100.
So it's basically doubled since 2017.
Right. And then look at their profit. I mean, look at this profit. So for those of you who are buying based on this 1 year PE, $31.4 billion in profit, guys, that's not sustainable.
Right.
How much of that money came from COVID?
Yeah.
A big chunk of it. I mean, look at their revenue from down 30% from the same quarter last year. Right? And that's why you see the stock stuck in this range. So look, in the last 5 years, it's only up 20% in the last 5 years.
Yeah.
Right? So you can click on this right here and go, okay, last 5 years, 20%. COVID, it was sub 30, went all the way up to 61.71 all-time high December 20th, 2021. And then right back down.
Yeah.
And I think people are starting to see this is, they made a lot of money, but that's not sustainable.
Right. And I'm looking at their oncology division. That declined 4% from the first quarter of 2022. So there are other issues in the business besides just COVID.
Yeah.
But at the same point, I mean,
Pfizer's a very, very large company. Look at this. 10 years, they're only up 43%. Fine. And let's see how their company, they're
going to be fine. It's just a matter of what do you pay for them and when do you pay that?
So in the last 5 years, their average free cash flow is $18.5 billion. But you got to strike out these 2 years.
Yeah.
So for a company like Pfizer, let's go to the extreme on the opposite side. Southwest Airlines. Their revenue fell like 95. I don't remember what percentage, but some absurd percentage. Did you value them based on their revenue falling 95% because of COVID? Of course not. So you can't value Pfizer on some one-off. And they did great with the one-off. They made a lot of money.
Exactly.
More power to them. They killed it. But that's not a sustainable avenue of business.
So in 2021, they did $81 billion in revenue, $100.3 billion in 2022, and they're expected to do $67 to $71 billion in 2023.
Yeah, that's a huge drop.
Yeah.
So you've got to do what's called normalize the income. Take the income and normalize it. Go back to the years in which they were just a regular drug company. Go see what's drugs in the pipeline. Mo, do you have a list of the drugs in the pipeline? If not, can you pull it up?
Yeah.
So whenever we talk about drug companies, you've seen this is why I avoid drug companies. For me personally, Mo likes them. Both of our fathers are doctors, and they're oncologists, and my father's still practicing, gets a lot of insight. His father still does consulting. However, for me, I look at it going, even when they get a drug, it's 17 to 20 years. And then it's just, not a business for me that's easy for me to value long run. But if you understand the drug funnel, if you can understand where they're, like, how is it looking for them, Mo?
So in phase 1, they have 38. Phase 2, 28. Phase 3, 23. Registration, 12. So I think that they're in pretty good shape.
Now, the question is, so what does that mean? Phase 1 is like the initial phase.
And where are they?
What was that?
And what fields of medicine are they in?
So there's two things. Phase 1, phase 2, phase 3. Those are obviously phase 1. Once they pass, they go to phase 2. Once they pass that, go to phase 3. Once they pass that, they're approved, right?
Yep.
And they're just getting into the, let's get ready to go. But what areas are they in? Let's say they had a drug that was approved for getting rid of, I'm going to make up something.
A super specific disease.
Hangnail. Like, how much money are they going to make off that? By the way, I just made that up. I have no idea. Or getting rid of a freckle you don't want. That's stupid because probably a lot of people would do that.
Or a disease that's very uncommon. That's one that people put a lot of energy into that, and they say this is great. It's like, yeah, but unfortunately, you're not going to drive revenue for that.
Yeah. A company like Pfizer needs to bring drugs in that are generating billions and billions of dollars per year for a 17 or 20 year period until they go off of. By the way, how much does revenue fall when a drug goes generic? What does it fall, like 85, 90%?
Yeah, it's a massive amount.
So what that means, guys, if you're not understanding that, is Viagra, for example. Yeah. When Viagra came out, Pfizer killed it, right? But after 17 or 20 years, they lose the patent, it goes to generic. Now, does that mean people stop buying Viagra? No, but listen, I'm on meds. The second they go to, like Propecia, I'm on Propecia, right?
Yeah.
Once it went to finasteride, I just said, okay, it's $8 versus $180. Why?
AbbVie is in that situation with Humira. They're worried about that thing is going to absolutely obliterate revenue and profit.
Absolutely.
Once they go generic.
Absolutely.
Once their patent expires. I mean, I'm looking through this right here. They have a lot of good drugs in oncology, immunology. I mean, this is a pretty good pipeline. Pretty good pipeline.
Is it?
Yeah.
All right. So there's certain percentages. I think it's something like 54% of phase 3s get approved or something like that.
Yeah.
But obviously, as you go phase 1, it's a lower percentage. Phase 2, a higher percentage. Phase 3 is an even higher percentage because they have to do their clinical trials. My father has a research business and he does clinical trials for these companies. He gets patients signed up and say, hey, do you want to try this clinical trial? There's blind tests. They don't know sometimes they're on it or they are on it. And that's how they determine, that's how they get their data to then go to the FDA and get approval.
Yep.
Right? Now, let's look at what the analyst estimates are for Pfizer in the coming years. Now, they're still showing growth, and that's interesting from this year. So they're expected to drop 48% this year on EPS to 341, but grow from here. Is it big growth? No, but look at this revenue number. Look at this revenue chart, Mo.
It actually shrinks. It goes up and then it shrinks.
Yeah. So look at that. Yeah. So guys, be cautious with Pfizer.
Yeah, be very careful.
I look at this saying, pick a stable. So what I'm going to do, we're not even going to use a stock analyzer tool. And the reason being is the stock analyzer tool is great for companies that have a base level and you can grow from there. This has a big drop and then this and then I don't know, but et cetera. What I would do is I would start with looking at this EPS and going, okay, in the next 5 years, they're going to generate around $4 a share. They're at 39 now. That's a 9.75 PE. Okay, that doesn't sound bad. So the question you have to ask yourself is, how reliable is this?
Right.
What are they doing? Let's see how their balance sheet looks now that they have all that cash from all those years. Yeah, look at that cash. Current assets, which is cash and all things that can be converted to cash pretty quickly. Let's call it $45 billion. $101 billion in total liabilities. They have research centers. Okay, it's not the worst. Low ROIC. That's interesting.
Yeah, you'd think that for. Let's go and look at some other. I'm gonna look at some other drug companies, see what their ROICs are.
Man, that's interesting. I'm actually surprised by this.
Yeah.
And look at this, Mo. Their 10-year ROIC is 7.8%. 5 years, 8%. So they are getting better. They are getting better, but obviously this is probably majorly affected by COVID numbers.
Yeah. I'm just looking through other drug companies, two other ones. One's at 16, one's at 18% ROIC.
Which drug companies?
GSK is 18.
GlaxoSmithKline.
13% over the last 5 years. Looking at AbbVie. AbbVie's 24% over the last 5 years, 16% this year. They're trailing 12 month. So.
Okay, so again, what do you do from here, guys? What I recommend doing on a company like Pfizer is, and I know this sounds funny, this community we have, 1,000 investors, that's where I would go to see what people are doing the research on Pfizer. Because I'm looking at going, all right, if analysts are right here and they're going to generate $4 per share in profit for the next 5 or 6 years, that's pretty good paying $39 for it. Mm-hmm. I don't like the balance sheet as much. I don't know, like to me, their long-term assets, I don't know about this.
Yeah.
Goodwill and intangibles of $95 billion. That sucks. Yeah. 95, I mean, goodwill and intangibles, I just strike out completely, right?
Yeah. And guys, if you want to try the community, $7 for 7 days right now. Try it out. Go talk to people about Pfizer if you're interested. See what the community is all about.
Yeah, is it worth $7 to go talk about one company? Of course it is.
$7 for 7 days. Link is in the bio below.
Yeah, so for this one, I'm basically going off of if you want to own Pfizer for the long haul. So let's go to Stock Analyzer tool and just let's assume, man, I can't even do that. It's $100 billion in the last year. That's not realistic.
Yeah.
It's not realistic for the company going forward.
This is a hard one. This is actually, for me, a too hard category, just because it might come out of the too hard category eventually.
So I will say this. If it wasn't for the stock being 39, I would agree with you. But Mo, let's say these guys are right.
Yeah.
Yeah, I know. That's quite the stretch. I know you're giving that face. What are their shares outstanding doing? Are they taking that cash to buy back shares? Yeah, they are. Okay. Well, they increased it a little bit this year.
A touch, yeah.
They have a nice dividend. What's their dividend currently?
They are paying
4% dividend.
Yeah.
But can they sustain that? $9 billion in cash. So, guys, look what I just did here. I went and looked at their dividend of $9 billion. And yeah, compared to the last year and the last 5 years, that's easily attainable.
It's a big chunk of previous years.
Let's look at the previous years before 2020.
More than 50%.
Their free cash flow. Yeah, but for a company like Pfizer, maybe that's okay.
Maybe it is because they're so mature and what else are they going to do?
Yeah.
I would prefer they buy back shares if the price was right, but...
I mean, I'm looking at the price right now going, yeah, why aren't they buying back shares?
Stop paying your dividend. But
if you really think you're going to generate $4 per share in profit for the next 5 years and it's selling for 9.75 PE, that seems like a pretty good reason to buy back shares, especially with such a crappy ROIC.
Yeah. That ROIC, though, might go and say, well, they're pretty terrible at capital allocation.
Yeah, but that's why you don't want them investing it. You want them paying it in dividends and paying it and buying shares back.
That's a good point.
That's exactly it. Like when there's a low ROIC, what that basically
within and just give it to your shareholders.
Yeah, just give it to the shareholders. Start distributing that money out. It basically says you're not investing the money at high rates of return, right?
Yeah.
So I look at this.
But also might say management sucks and they don't know what to do and they are going and doing other things.
So if management sucks, though,
and that's why ROIC is so low.
But if management sucks, I want them buying back shares at cheap prices.
But maybe they're not. But are they going to start doing that? That's
I don't know.
Question.
Can you look it up, Mo? See if they have a plan for share repurchase.
Sure.
Guys, so while Mo looks this up, remember, free cash flow can be used to do 5 things: pay down debt, buy back shares, make acquisitions, invest back in yourselves, and pay dividends. If the company doesn't have, companies tend to overpay for acquisitions. And if they're overpaying for acquisitions and they don't have much room for investing in themselves, because they're probably already spending how much in R&D? Let's look at their R&D expense. I mean, yeah, it's huge. 11% of their revenue in the last year, but in previous years it was like 20% of their revenue. So they're already investing in R&D. So from there, the only things left are pay a dividend, pay down debt, and buy back shares. And the company seems cheap if they're able to just keep their current, even if they create $3.50 a year, they're selling for 11 times, buy back shares.
So no share repurchases have been completed to date in 2023. As of May 2nd, 2023, Pfizer remaining share repurchase authorization is $3.3 billion.
That's it?
Yes. Yes.
Huh. $3.3 billion. The market cap is $218 billion. They're buying back 1.5% of their shares. Poop in the butt. You know what I would want to do? Cancel his dividend, start buying back shares.
Yeah.
If they really think they're going to generate $3.50 to $4 a share in profit for the next 4 or 5 years, go ahead, Mo.
Current financial guidance does not anticipate any share repurchases in 2023. So they're authorized for it, but they don't have any plans to do it.
Interesting. Yep. Interesting. Don't get suckered into this PE of 7, by the way, because of the fluke last year. Wow, look at this. Good margins, though. All right, guys. On Pfizer, join the community. Learn more about it. You get all the tools here, $7 for 7 days. And don't forget, this Thursday, 6 p.m. Eastern time, options where if you own Pfizer, we'll teach you how to make a few extra percentage points on Pfizer every year, selling covered calls. And if you want to own Pfizer, how you can get paid to wait for Pfizer to hit the price you want. All right, now for TRowe. Guys, full disclosure, I'm a fan of TRowe from a long-term perspective. Now, I want you guys to understand something as we do this video. When we do Stock Analyzer tool, I'm going to do two versions, one with a 20-year outlook and one with a 5-year outlook. Why? Well, TRowe's in the money management business, and I believe stocks are very overpriced right now. One of the things they announced in their first quarter is they lost $16 billion net outflow of money out of their funds. Yep. And I think that will continue. When markets go down, people tend to pull money out, okay? And as markets go down, their revenue profit is going to fall. So Mo, how do they report? Tell us right now.
So came in $1.69 versus an expectation of $1.65 earnings per share. So that's a beat. And revenue, 1.54 versus 1.53 billion. That's a beat. So they beat on top and bottom line. Look what the price is doing now.
Let me look at the price. I'm hoping it's down.
It's down.
Is it?
Yeah. And this is
why.
Oh,
wow, 4.5%.
Exactly. And this is why earnings are, like when I explain to people that trade, be very cautious with this because we've seen so many companies that have reported beat on top and bottom line and boom.
And look at Sprouts Farmers Market. By the way, one company we're watching, it was up 14% at one point today because they beat. All right, so they're down 4.5% right now. That's pretty incredible.
Yes, it is.
But look at this, Mo. All-time high in August of 2021 of $224 a share. Market cap, $25 billion. That's what I love. Enterprise value, $25.5. Wow. So basically the same thing. Yep. Compare that to a company like Schwab that has a ton of debt. Now, obviously, Schwab has banking and things like that, but I love the fact this basically means they have very little debt, if any. Mm-hmm. That's what I like about this company, all right? PE currently of 16, 5-year P of 11.5. Look at these margins. Gross margin, 55%.
Huge.
What does 55% gross margin mean? It's very simple, guys. Every extra dollar that comes in, 55 cents of it goes to be able to pay overhead and income taxes. If their revenue went up $1 billion today, they'd probably add $550 million to their bottom line before taxes because their overhead doesn't have to go up to go manage an extra $1 billion in revenue, more or less. Okay, I don't know if that's true or not, but the whole point is it has to get into levels before they have to add overhead in order to pay all these things. So a high gross margin business like this is very desirable because as they add more and more money to it, it's going to keep driving that bottom line. And you can see right here, not a lot of overhead. 5-year average profit margin, 35%. Last year was 24%. Okay, so again, like you said, $1.69. Yep. Let's look at what they made same quarter last year. I'm going to do per share quarterly. Last year, per share in the same quarter, they made $2.49. So that's a big drop. Yeah. But what happened last year?
I mean, market has fallen a lot.
Market's fallen a lot, guys. When the market falls for companies that charge asset management fees, the revenue and the profit's going to fall as well.
Yeah.
That's just the reality of it.
And the thing is when I went back to 2008 and looked at the revenue, they had a dip, and then right when markets started to rebound again, inflows came right back in. So it does have that cyclicality of bad times, good times, but more often than not, we're in good times.
I will say, though, revenue didn't fall as much as I would have thought. 1.86 billion down to 1 point. Oh, no, that's 20% drop in revenue. Yeah. But guess what? Stocks fell about 20% last year, so it makes sense.
Exactly.
All right, let's go check out the 8 pillars.
They're good, except for one.
Net income. That's the only one that fell.
Yep.
And that could be for a myriad of reasons, but everything else is good. High return on invested capital, 17%, guys. TRowe, in my opinion, is one of the leaders of 401k.
Yes, they are.
It's a quiet company.
Correct. That's the thing that I love about them. They're so quiet.
It's just, there's no glitz and glamour. It's just a quiet business that has low debt and generating good profit and a high return on invested capital. What does this return on invested capital mean? It means they get a high return on the money that's invested in the business. It shows a moat because it's hard. They don't have to invest a lot of money, as much money to generate more and more profit. So let's say that, for example, as the world expands, they want to expand into Asia and Africa if Africa becomes more developed. Mm-hmm. They can go out there and deploy $1 billion into each region or $2 billion and say, we're going to go try to dominate this area or try to get some business from here.
Right.
And if they go invest $2 billion, they're likely to add 17% of that to the bottom line every single year. That's a very, very high return. That's how companies compound. You want to pay a premium for these companies. All right, look at this debt. They can pay off all their debt with less than 1 year of free cash flow.
Yeah, it's hard to
Go broke.
Go broke and go into bad time, like very bad times with that.
Yeah. And look at this 5-year price to free cash flow, 13. 5-year PE, 11.5. Okay, let's see what analysts are saying. And remember, guys, if you have our software, you can edit the pillars to have up to 12 of them of your own. You can edit them. There's like 4 quadrillion different variations you can do. So another great reason to sign up for the software. We're running a special $7, 7 days, $1 per day. Even if you have one stock to look at, even if every one of our tools is worth over $1 a day. Literally, and we have how many tools here? We have so many tools here and the community of thousands of like-minded investors. So no brainer, everythingmoney.com, check it out. Analyst estimates. I mean, Mo, look at this. Again, it's analysts, so we take it with a grain of salt, but they're showing profit here. They're expected almost $7 a share this year in profit. All right, but revenue, look at revenue. Revenue is going to be pretty flat for the next 4 or 5 years.
Yeah.
According to analysts.
According to analysts.
By the way, I actually agree with that. If I believe the market's overpriced and if stocks are going to fall 30, 40%, you better believe they're going to see a big drop in their revenue. But they also have the benefit of what? Every person in their 401k.
That's the thing, and it's hard to leave 401k. I mean,
not only that, but every pay period, they're getting automatic deposits.
They're getting automatic deposits, and you don't think about it. You just say, you know how much work it is to probably get out of one of those and stop it? It's probably more work than it's worth.
Yeah. And that's the great thing about 401k. People just put the money in automatically from their paycheck. They don't have to think about it. Automatically goes in. That's what I love about TRowe. All right, so what's the price to pay for TRowe? Remember, I'm going to do a 20-year, and Mo, why don't you do the 5-year analysis, assuming the drop in revenue? Because I want to show you guys the differences based on your outlook. So it's very important you stay for this entire thing because you got to see the difference if your outlook is 20 years versus 5 years. The hard part about a 20-year outlook is buying a company knowing that 20 years from now, it'll probably be it's a good buy today for 20 years from now. But in the short run, you have to endure some pain. Okay? So we're going to pause right here real quick. We'll be back in 2 seconds. You won't even notice it. We're just doing our analysis right now. All right, guys, I'm going to show you my assumptions, and then we'll ask Mo.
Okay.
So first off, revenue growth for a 20-year analysis, and you can do 1 to 20 years on our software. I did 3, 5, and 7. Mo, what'd you do for 5 years?
I did a -1, 1, and 3.
See, I actually think that's too high.
You think -1 is too high?
Yeah, I think you should be at like negative. Yeah, because look at it. If we believe stocks are going to fall 30, 40%.
Yeah, but the question is, my thing that I always default to is how fast do they rebound? And if they do rebound quickly, then people
do me a favor. Do -3, 0, and 3.
Okay.
So I'm assuming 5 years, they're going to have, on the worst case, -3% revenue growth a year. That's almost 18%. That's like 16, 17% revenue loss.
Okay.
And on the high side,
on
gaining.
Top of what they've already had.
Yes, correct. On top of what they already had. All right, profit margin. I did 25, 30, 35.
So I did 31, 32, and 33.
Okay.
I don't think it's going to change much.
Free cash flow, 25, 30, and 35.
I did 25, 26, 27 because they're 10-year average.
Yep. PE, I did 15, 16.5, 18 because they're high return on invested capital up here. I'm willing to pay a premium for them as they get better.
I did 15, 16, and 17 for PE and price to free cash flow.
Perfect. And my desired return, I did 10, 12, and 14. Now, really quick, the reason I did 10 here is these are all such low assumptions. I don't need a discount. I don't need to give myself as big a margin of safety. But as I make higher assumptions, I need the higher margin of safety. Mo, what'd you do?
So I actually did 10, 11, and 13.
Yeah, I don't blame you. Okay. Analyze button. Ready for this, guys?
All right.
Green City. 107 is my low, 162 is my high, 133 in the middle. Remember, my 162 value is based on a 14% return. Mo, what'd you get?
I have 83 to 103 on the low end, 113 to 140 on the high end, 100 to 120 in the middle. So guys, do your research. Don't just buy this because it looks green here. Make sure you understand it. Join the community. Again, this is a long-term play, but I'm a believer in it, but don't buy it just because I do, because I'm going to be wrong 50, 60% of the time. But when I'm right, hopefully it works out well. Just go out there, subscribe to our community. Don't forget the webinar, 6 p.m. Eastern time on Thursday. Thank you very much for your time.